Yeah, good morning, everyone. John Hutchinson and Jeff Wood with Breakfast Club, Monday, November 17th. Uh, Good deal to cover today. Jeff is finalizing his slides, so I'll get you underway this morning. Quick weekly update, things that are happening. The Fed's sending mixed messages last week. Uh, some of the Fed governors saying rate cuts, some saying no rate cuts. So that had an impact really on the latter part of last week, um, and contributed to the selling pressure mainly on Thursday. The tariff announcement on the tariffs between the U.S. and I guess a major trading partner, Switzerland, uh, helped boost the market on Friday, and then late Friday, the removal of tariffs on certain food products for all you folks who buy Australian lamb beef. I guess you're paying less now. Uh, but the other thing that I think we need to pay attention to is that the clock is ticking on the Fed. Um, and we do need to start taking that into consideration because Jerome Powell's term expires May 2026. And if he's not brought back, that's the probability of one or two seats on the Fed being swung to um, rate cut people. I guess the simplest way to put it. Um, I think that's an area for me. It's an area of concern. Um, Rapid rate cuts are a defensive measure, not an offensive measure. Uh, and while it's helpful for the market to have a view that the Fed is in a rate cut cycle and that should would or could head off the potential for a recession. Um, this drive to cut by half points is not healthy. Um, and Although I don't have it on the slide here, a couple of things that I've been watching on three things. One, uh, struggling small businesses. So, an appeal, if you will, if you're shopping for Christmas, shop small business because they need the help. There's a story last week in the Washington Post. Small businesses are getting crushed under the weight of tariffs for those that are dependent upon products from foreign countries. Uh, they are not hiring because of the cost of tariffs. This is the first. It was the first story that, to a degree, supported my thinking, my theory that businesses are trading tariffs for hiring. So please shop small business. Uh,
They're also trading tariffs for Black Friday sales, and that's
it,
annoying. I want to shop on Black Friday.
I'm telling you, keep your eye on Black Friday, Cyber Monday, and Christmas sales at retailers. I one of it swings one of two ways for me, Jeff. It's either it's the what is it, December 31st, 1919, the day before Prohibition, right? The New Year's Eve before Prohibition went into effect, and everybody had massive parties. Right? It's that big spending, and then we're just going to close our wallets. That's one swing, and the other is if we really are dealing with a bottom up recession, um, what they call it, a K-shaped economy. But if the bottom end of the economic scale isn't spending at Christmas, then that starts to have upward pressure into middle tier retailers. Your Best Buys from Walmart to Target to Best Buy, etc. So if we start to see uh, less than enthusiastic results coming out of Black Friday weekend, that's a tell heading into Christmas. If we have a weaker Christmas, I think we start heading into the potential for recession in the first quarter, maybe the second quarter. Not predicting that, just laying the groundwork that's that that would tell me that consumers are significantly pressured, um, and, uh, and not spending. Um, I did have an amusing thought though, because Jerome Powell has typically been dovish. He is not a hawk. Uh, so the weird thought that I had over the weekend was, what if he survives? What if he actually stays as as chairman of the Fed. Now, I don't think that's likely, but but he's not the roadblock. This is one of the mistakes that the administration, well, that Trump keeps making, pointing the finger at Powell. Powell's not the guy voting for rate hikes or no rate cuts. He's voting for them. So it's like you're picking the fight with the wrong guy. But the other biggest issue that I really see right now is the black hole of data from late September, October, early November. It's both a problem and a mistake. It's a mistake because the read on it is that that data was negative, and the jobs data for October, jobs data for November, and the mistake is not releasing it. And this is becoming a feature of the mistakes that, and I apologize for being critical of Trump, but this is a mistake that they keep making, which is hiding data that A would actually support the Fed cutting interest rates, i.e., jobs data, if it was negative, or hiding data because it would not support the case for rate cuts, in which case the economy is doing better than people think. So, the one of in my view, my opinion, love it or hate it, one of the things that I've always appreciated about the Bureau of Labor Statistics is transparency. Whether it's good news or bad news, they give you the news, and not having that data be released it's a mistake, because you're again the market is Wall Street is reacting to private source news, which is not as broadly based statistically, which decreases it. This is impossible to say together. It decreases its statistical validation. Drink 5 beers and say that 5 times fast. I dare you. Um, or 3 cups of coffee if you prefer. I mean, it's Breakfast Club, right? So, um, and it's both a problem and a mistake. If the jobs reports would have been negative for October, you should have just released it, and because Wall Street can recover from that. Now you're going to get a December report, maybe. I mean, I assume you're going to get a December report, but what's going to happen is at some point all of that data is going to catch up, and the numbers are going to be either the potential for a stunning negative number. For example, if the BLS in March does their next major update, that it's anyway. I'm going on and on about it. I think it's a mistake. They should have gone back and released all of the data that was necessary, regardless of whether that data was positive or negative. And there were, however, significant moves by hedge funds last week. Hedge funds and institutions exiting stocks. One of the ones that I caught was Coherent, COHR, which was in our momentum portfolio in AI2. Bain Capital exited a $10 billion position on Coherent last week. That's not a small move. Now, the question that you have to ask is whether they're trying to, across the board, hedge funds, institutions, are they turning bearish? Are they simply taking profits? Are they trying to push the market lower so that they can buy back into stocks at lower prices? It could be uh, any or all of those possibilities. Possibilities, excuse me. Um, so the key in the fourth quarter at the end of the fourth quarter here is, especially after the Fed meeting, what do institutions do as they move to rebalance portfolios heading into the new year? And the potential exists for the market to go down in the last 7 to 10 days of this year, even the beginning of the year, if those views are turning bearish, or if the valuations on the market, which we will look at as we get into December and we get numbers for the next year, um, if they turn more negative. Uh, on the opposite side of that, for 2026, full year EPS for the S&P 500 has been increased from, I believe, 299 to $305 a share. So That's a small positive. It decreases the multiple on the S&P a little bit, not substantially. But if analysts are viewing uh, the S&P 500 more favorably, then we sort of have a mismatch. We certainly had a rollover from tech to non-tech last week, but the hedge funds and institutions do that regularly. Uh, they did it in the summer. They did it back in, certainly did it in April. And eventually they pile right back in. So this may be a period of patience, and especially as it relates to stocks that are more technology focused, certainly more AI focused. Uh, but the stories, the narratives are all intact. Nothing has changed in a week. So with that, some things that I wanted to share today. A, over the last month, I've been making some major advances in the development of the AI2 index. And while you may or may not be part of AI2, uh, there's a little bit of a surprise coming at the last of my slides here. So I'll roll through this somewhat quickly. But the new version of the index is coming soon. I started with a universe of around 1,300 stocks. Uh, once I worked my way through primary scoring of whether those companies are or are not AI related in any capacity, and have the fundamentals that would be of investment quality. I got myself down to a universe of just over 400 stocks, and then from that, I'm building the core index of 150 stocks. But the major advances that I've made in the last month, one is dynamic scoring, so I can update the index on a weekly basis. This allows us as investors to see when stocks are being added or removed from the index, stocks that are moving from the bottom to the top of the index or from the top to the bottom of the index. And the index will largely be fundamental driven. So that's earnings, revenue, growth, things, metrics like that are driving the real scoring methodology behind this. And I now have the ability, as I shared a little bit last week, to project price out from 1 to 5 years into the future based on earnings expectations, because I now have access to 4 years of forward earnings estimates. So that was a major discovery. And it's exciting because I can do things that I never could do before with my discount model. Um, and then finally, the the real the real power for me right now is the ability uh, to score and weight a company that is pre-profitable or negative earnings, and to identify companies, especially where their negative earnings has upward momentum. So, for example, a stock that loses $1 1 quarter, then loses 50 cents the next quarter, right? They're on that path to profitability. I now have a mathematical model that can identify those types of companies. And what that really helps me to do inside of this index now is to identify potential 10x stocks. Those are 10 baggers, especially from the micro and small cap realm in the $10 to $20 range. So I'm excited about the future. So one of the things that I did was I sent the math model out to a third party, and had the index scored against three somewhat competitive views. So the first one was scoring it, assessing it against the Bloomberg Artificial Intelligence Select Index. And I didn't win every category. A couple of the categories that I didn't win, for example, were ESG screening, which I'm not going to do in this index. It's a retail focused index. I'm not worried about environmental, social governance. That's what ESG stands for. And the the Bloomberg index is for institutions. Mine is not. Mine is for regular folks who want to buy stocks. So the real advantages here were on the minimum market cap at the very bottom there, where 10 million is essentially the minimum, and that allows me to capture small caps and future small cap movements. And the advancement in a dual score, specifically around artificial intelligence, being an AI score. In other words, whether how the company derives revenue from artificial intelligence, and then a fundamental score, which is the quality of that revenue in terms of earnings. And then the other major valuation was the valuation focus, and adding in two components for companies with positive earnings and companies with negative earnings. That was a major move for me. I'm also covering more stocks. My core index will be about 154 stocks, but my total universe being over 400 gives me much more quality to choose from. Then it was compared against the Robo Global Robotics and AI Index. That's ROBO is the ETF symbol. Uh, Essentially, I won. I'm doing well, so I'm excited about this. And again, this is being more pure in the AI focus. Although there are some robotics, because there's an artificial intelligence component to them, the broader theme of the Robo ETF was a little bit of a drawback for them, a little bit of an expansion for me. Uh, the other main advantage is in the growth to discount, being aware of valuation versus being the robo equal weight and or market cap driven. So and they don't have enough small caps, so they were underweighted in small caps. We are not. Uh, and then finally, uh, my semi-hero Kathy Wood. So it was assessed. The AI2 index was assessed against her ARK fund. Um, and the main difference here is in the rules-based approach and developing both mathematical and scoring models to build a dynamic index. And what that allows for is transparency and expected reliability in the performance of that index over time. Uh, the other is focusing on growth at a discount means we're taking on less risk. We're buying companies where the risk factor in the value of that company is lower versus, say, a Palantir. Uh, and a more diversified approach because of the different sectors and industries that I'm able to capture, everything from software to software platforms to obviously semiconductors and chips, down to utilities and basic materials companies. That broader diversification gives me a little bit of an advantage. They are different business models, obviously. ETF versus an index. My index, not the same thing, but ultimately, to be able to compare myself or have my index compared favorably uh, gave me more validation on the methodology and more confidence in the way that I've developed it. So as we move to uh, release the new AI2 index, I'm really excited for you, all of you, because you're going to get some institutional quality information, easy to use. That's the biggest thing that I'm aiming for here. So this week I'm building the engine and the output. So I expect to release the new index next week. As I shared a little bit last week, it'll include more data and detail on the stocks that are in the index. So you're not just flying blind. You get to understand what the company does, how it's related to artificial intelligence, what its fundamentals are, why it's that's the why, the transparency. Why does this company score in the way that it does, whether it's on an artificial intelligence scoring or on a fundamental scoring. And then the scoring model is now automated, and that will allow me to do dynamic updates. I'll largely update most of it on a weekly basis because anything more than that is overkill. I don't need to update it every single day. And then in March of this year, what I'm planning to do during the AI2 Wealth Conference is to show how I can expand the scoring methodology beyond AI stocks. So for folks who are looking for high quality dividend stocks, for folks who want a universe of small caps that are not necessarily specific or are not at all related to artificial intelligence because they exist. Building a growth portfolio or a conservative portfolio, there will be different models that will be accessible once I finish all of this off. So while my main focus will be on AI2, we'll have the ability to expand beyond that, and that makes this more accessible to a broader audience of investors. So we're coming in March, and essentially what I'll be able to do is eliminate ETFs. So that's just my humor for the day. Anyway, all right, Jeff, are you ready to roll?
I'm ready. Let's do it. Let's
All
go.
right. Screen is yours, my friend.
All right. Good morning, everybody. How's everyone doing? Let's see if this let's see if this works. You never quite know on a Monday. What's what ghost lives in your machine from the weekend? All right, so welcome back, calendar. Yes, the government shutdown has ended, which means we now get data from the government. And again, this helps us, I don't know, maybe not trade blind into the week, but sometimes data doesn't really help trading because then it gets investors all nervous and everything else. So the next 2 days fairly light, which is nice. Wednesday we get FOMC meeting minutes. Everyone, of course, is afraid that the Fed now doesn't want to lower interest rates again in December, and so that's causing a sell-off in tech stuff. So, and then Thursday we get more unemployment data, which is of course the big news that everybody wants to see is just how bad is the economy, or is it, as John mentioned, is it K-shaped? So the lower incomes are struggling and everything else is doing fine, or is it, is it bubble shaped? Is it whatever shaped it is? So we'll get more of that on Thursday, but at least the data is now starting to come back. As John mentioned, I mean, the data has always been there. Whether it will ever get released afterwards, probably not. But at least going forward, we'll get more data coming through. So one of the things I wanted to talk about is, full disclosure, all of this sort of happens after the fact, meaning if you're looking at new 5-day highs versus 5-day lows, you actually need to, you're looking to see if stocks have made new 5-day highs, which means that they've moved for 5 days to make a high. So some of that initial move, we're going to be a little bit late if we're looking at an indicator like this, because to get this to be green, that means we had to have new, more 5-day highs, which means, stocks have already had to move up for 5 days. But I'm looking at this more as a market breadth indicator. Sorry, my cursor's right in the way. I'm looking at this more as a market breadth indicator. We've looked at this for a couple of times on these Monday sessions, and the number of new 5-day lows as of Friday definitely outpacing the number of new 5-day highs. And Friday, if you recall, was a very interesting day in the market where we had gap lower. We were moving stronger into most of the pre-lunch session. Then all of a sudden we went down, then we came back up, and then we went down, and it kind of got a little rocky in the afternoon. But if you look at what's kind of happening underneath everything, still a lot more 5-day lows, and you're like, okay, fine, that's 5 days. It's been kind of a crazy week. But if you look at this, the number of new 3-month highs versus lows again outpacing new highs. So what I'm waiting for, this happens in a wave. So I want this to turn green, this to turn green, this to turn green, or if they all turn green on the same day, that's fine too. But right now, we just have to be a little bit cautious, which is unfortunate because typically November, December, good bullish months in the market. I mean, these are supposed to be some of the 2 happiest months of trading. But what I'm kind of waiting for before I go too crazy into my account, or up the number of contracts or up the number of shares or anything else, is I'm kind of waiting for that 5-day high to start turning green before I start putting more into the market. Now, interesting, this is the CNN fear index versus the 52-week highs. So net overall for the year, we still have more 52-week highs. We're above 0%, but we are in this extreme fear area of the CNN index. Now, I will say, I think I showed this last time. Investors tend to be really bad at picking lows. So there's rarely been a time where the CNN index says investors are extreme fear and that picked a high. Usually extreme fear is picks market lows. So it's inverse because investors get very fearful. Essentially after the move has already happened, then they get very fearful, and then that's when we start turning around. So there's a couple of things that this is there's no good set of data right now that says, where investors are thinking. So extreme fear, yes, but we also have 52-week highs, trending lower since the beginning of October. So in this case, the data sort of supports why investors are at that sort of extreme fear level. But again, extreme fear tends to pick market bottoms, not market highs. If you look at the sectors trading above the key moving averages, one of the things I wanted to point out, the saying goes, nothing good happens below the 200-day moving average. The S&P 500 index only has 56, only about half of the stocks, 250-ish stocks, trading above their 200-day moving average. So that's why we're getting into this just sort of sluggish period right now. We're just kind of waiting to see what the market wants to do. Of the strongest sectors, though, we still have energy, with 86% trading above their 5-day moving average and 100% still trading above the 20-day moving average. So again, talked about this last time. Normally, when you have 80 to 100% of stocks within a sector trading above their 20-day moving average, that tends to be a time where that sector is a little bit overbought. If it's 20% or low, that tends to be that stocks in that sector are oversold. Doesn't mean that it's over. It can stay at 100%, it can stay above 80% for a week or two, but that's when you want to be a little bit more cautious about getting into that broader sector. There may still be strong stocks within that sector that stay above their 20-day moving average for a long period of time, but broader strokes, that's when major hedge fund start saying, hey, the move has already happened in energy. That's when we're going to start getting into other things. And so if you look at it, information technology, only 25% of stocks trading above their 20-day moving average. Real estate, 23, although real estate is just, it's a funky index anyway, or sector. So we do have some of the, industrials, information technology, even financials coming down a little bit. So we have some of those stocks that if they start turning around, then obviously that will really help move the market. Right now, we have consumer staples, we have energy. So these are, healthcare. These are some of those more defensive sectors. The defensive sectors aren't exactly overbought either. And so we just have this mix mash of data right now. But I do like that information technology is getting so low that's when you start getting value investors coming in and starting to bottom fish on some of the stocks that have been hit the hardest in information technology. Information technology, of course, tends to be the more riskier, or it has some of the tech stocks. And so if those start flying again, then we'll see the market kind of turn around. Overall, the S&P 500 over the last 5 days, flat, with, like I said, energy, healthcare, some of those stocks leading the way. But materials, I like seeing materials kind of come back around and be one of the gainers, although they had a pretty rough day on Friday. But if we can see materials, we see industrials kind of helping move higher, then we start saying, hey, maybe the economy is not so bad. And we'll see this thing, turn around. I mean, overall, I don't mean to sound like we're falling off a cliff or anything like that. The S&P 500, this is looking at Heikin-Ashi candles. Heikin-Ashi candles helps smooth out the trend. They're a little bit easier to read if you, but I guess it depends. I mean, if you read candlestick formations, then obviously you don't want to read Heikin-Ashi candles because that kind of smooths all of that out. But what we look for, or what I look for, is essentially a green campaign or a red campaign. Green campaign, obviously bullish, red campaign, bearish. And I tend to look for 2 red candles in a row to start a red campaign. So we had that on Friday. Despite all that move on Friday, we now have 2 red candles. So we have a red Heikin-Ashi sort of cycle here, or campaign. That said, if you look at the overall market, though, we have lower highs, but we also have higher lows. Even on Friday, that that Heiken Ashi low never made it past this low early in November. So we now have this wedge formation happening. So we get some bullish news, we start moving higher. If we can break out of this wedge, then that's good. If we break below this wedge, then we're going all the way down to 6,600-ish, which is also another big number. But that's where kind of that next line of support looks like. Maybe there's a line, 6,700. Again, these are those big numbers. So, but that's kind of where, at least on the Heiken Ashi candle, that's kind of where we closed anyway. Was 6,700. Remember, Heiken Ashi candles open, high, low, close don't match up with the actual open, high, low, close. So just be aware of that. And then this is what the S&P looks like on a weekly chart. Wanted to show this because we actually had our first red Heiken Ashi candle. It is a doji candle though, so it is just something to take caution of. Same wedge. This is just looking at a weekly chart. And if on a weekly chart we break through that wedge, then we start going down quite a bit before we see any sort of Fibonacci support level. The 23% retracement would be 64, 61. So, and we're trading at 67.34. So quite a bit lower. So this next couple of days, very important to see if we can make that switch and break out of this wedge and start moving higher. Or if some of the data starts saying, hey, we need to be a little bit more cautious here. The Qs on the daily chart, they actually have made new lower highs and new lower lows on the Heiken Ashi candles. So again, it's just time to be a little bit cautious on the Qs. It depends. Again, you can either be a bottom fisher and say, hey, things are getting beaten up. I'm going to start dipping my toe in and see if we can get a reversal here. If you're a trend follower, then this is definitely not the time to be in the Qs. You need to wait for this trend to reverse before getting too heavy into the Qs. Again, this is the fear and greed index, pegged down at 21, which again is that extreme fear level on CNN. So investors very, very cautious here at this level. And the last time we were, the last time we were here was earlier in October. It was like that October 10th-ish date. But the last time we were here was really all the way back in April, when all the tariff stuff was initially announced. So, and then, not saying this is going to happen, but we saw that really nice bounce after that. But that bounce was caused by sort of a relief in the tariff valve of, hey, we're not going to really do all these tariffs like what we announced. We'll kind of back off from that. And so the question is there any sort of catalyst that is going to help move us and give investors some confidence that things are moving in the right direction? Equal weighted index, I know we're at time, so I'm going to be only a few more slides here, but equal weighted index. So this is the entire USA group of stocks. And yes, we so this is EUSA is the ticker. And what I like to look for is, are we trading higher than we were 5 days ago? So this is what, 101.65. And if we count back 1, 2, 3, 4, 5, that close was above 102. So this is over the last 3 months. You can see the equal weighted index of all USA stocks over the last 3 months really hasn't done anything. So if you are seeing any sort of gains or S&P 500 gains in the last 3 months or so, that it's coming from a very few select group of stocks. It's not really coming from the overall market. And again, I'm not saying that this week isn't going to be a bullish week or that we won't see a turnaround or anything like that. What I am saying is, before getting too far into things, I'm personally cautious on the bullish side until we see an EUSA kind of beating where it was trading 5 days ago. And it tried to do that on Friday. It did get above 102 up on Friday. It just closed, down at 101.65. So if that starts moving a little bit higher, then that's when I start saying, hey, from a timing indicator, I'm going to start dipping my toe in and trying to find some bullish trades. Right now, I'm just kind of sitting on the sidelines. And again, this is the equal weighted S&P 500 stocks, or RSP for that ticker. Same sort of thing. Doji on this one, it tried to get way up there. on Friday. Then it ended up closing really right about where it opened, and where it closed is still less than where it was 5 days ago. Pretty close, but still less than where it was 5 days ago. So again, just a little bit more of a yellow flag here. You can dip your toes and try to find some stocks, but I wouldn't go all in. Maybe reduce position size, maybe reduce how many positions that you want open, tighten up stops, whatever you want to do. Two levels to watch in the S&P 500 this week. This green line, so 68.53, this red line, 66.15. Those are, that is the expected move for the week based on Friday's close. And you can see this is 1, 2, 3, 4, 5 days of data. You can see that in 2 days, actually in 1 day, pretty much, on Monday of last week, if you recall Monday of last week, we had a really good, this is where it closed. This black line is where the previous Friday closed. We had gapped higher, moved all the way up to the expected move of the entire week, all in 1 day. And then we actually, the next 2 days we tried to push above the expected move on the S&P 500, and then we quickly reversed, came all the way back down, almost even hit the expected move on the lower side. So it was a very volatile week last week. So this is kind of where I'd look for, historically there's 68% chance that we stay within the expected move for the week. So if we open up today a little bit lower and we get down to this 66.15-ish or somewhere, in that sort of lower half. So if you divide the black line to the red line in half, and then we get into this like lower quartile here, that's maybe when you want to start dipping your toe into some bullish trades again. If we start taking off higher, just be aware that we're pushing higher of the total expected move at that 68.53. And on the chart, that's what this looks like. Is if we get down to this yellowish line, that's that 66.15. That's that lower end of the expected move. If we get higher than, up to the 68.50, that's that higher end of the expected move, which coincides with the last swing high. And then the 66.15 sort of coincides with all of this messiness. That this is actually when we were in Vegas trading this mess after that big October 10th drop off. So those are your kind of two ranges for the week ahead, and just play it cautious. Look at some of those market breadth indicators before you go too big. Lastly, I'm going to end on this seasonal trends, because this is something that we don't do really in any of our other groups, which is why I like to do it on Monday, give you something a little bit different than what you're used to or what we do in other services. So seasonal trends, are they going to hold up? John and I kind of joked around about, we're not joked, but talked about where the market was going to go with Black Friday sales and everything else. So historically, I'm looking at the last 10 years of data, and I'm looking for stocks that have moved up in a certain time frame 80% of the time in the last 10 years. So 8 out of the last 10 years, I'm looking for a move higher. So look at this. Bath and Body Works, ticker BBWI, has moved an average 20, unless that's a typo, 20% over the next 28 days. Alta Salon Cosmetics, ticker ULTA, moves an average of 4.2% over the next 26 days. And again, this is over the last 10 years of data. 8 out of 10 years have moved higher by and overall, even taking in the losses and everything else, the average move ended up being 4.2% over the next 26 days. Nike, 6.4% over the next 26 days. Estee Lauder, 11%. McDonald's, that doesn't really fit in with the whole retail story, but they eked out a little bit of a gain over the next 7 days. And the other one that I thought was interesting is I started seeing, and we actually even traded this in 3 stock too, but some of the brokerage firms tend to trend up towards the end of the year, again, with people sort of settling accounts, getting ready for tax seasons and whatever else. Some of those fees start going up, or people start paying fees and reconciling their accounts, commissions and all that other stuff. So Charles Schwab, on average, goes up 3.6% over the next 34 days. So consumer staples, one of those things that I talked about a few slides ago, being one of the strongest sectors. As the last week we rotated out of tech and into some of those defensive sectors. So I said, okay, well, is there a seasonal trend? I mean, obviously the seasonal trend over the last couple of months tends to be retail, but is there a seasonal trend on consumer staples? And actually, Conagra Brands, or however you say that, CAG, over the last 20 years. So I went all the way back to 20 years, and it's moved up 85% of those 20 years. And it's moved up over the next 32 days. So that's sort of that seasonal window for CAG is over the next 32 days. Average return, not that much, about 3.44%. But that is, a percent a week ish, almost. I guess 32 days would be 4 weeks. So almost a percent a week. It did have a losing trade. The last losing trade was in 2024 by almost 0.5%. But 85% of the time over the last 20 years, the stock has moved up. Again, in a strong seasonal thing like what we have. I mean, I'm looking for a percent a week, but if we're really moving out of if the retail story is not going to hold this year with tariffs or whatever the reason, then maybe I'll look for something less than 1% a week. But anyway, so these are just a couple of ideas for you. You can take a screenshot of that. You can always, either buy stock, you can buy debit call spreads on these. If the implied volatility is high enough, you can sell put spreads on these to take advantage of seasonal behavior. One of the things is, again, just the way that the number of stocks trading above 20-day and 50-day or even 200-day moving averages right now. I wouldn't just go in and say, oh, well, Jeff said average of the next 20 to 8 days, Bath and Body Works goes up. I'd still look at, are we trading above a 5-day moving average? Are we trading above a 20-day moving average? Are we trading above 100-day or 200-day moving average? I wouldn't just get in just because seasonally it says to get in. I would look for, whatever sort of entry timing indicators that you like to use, MACDs or RSIs or whatever the case may be. But just know that these can be added to your watch list depending on how you like to trade. It may be worth checking out. So, and that is it, John. Sorry I went over, but that's it.
Sorry, we're going to take a look at a few more things. Joe, I'll ask Jeff and Dave. Jeff, if you could make a note of this to give some updates on the remaining positions from the MTC Live during your Monday session today. Joe, I think one of the things that we try to be careful about is not confusing people between positions that are part of just the MTC service versus those that were traded at the event. But I'll ask Jeff and Dave to make sure that they cover that this week. Thanks for the question on that. One other area that is at least worth keeping an eye on as potential trades is the BNPL. That's buy now, pay later crowd. So we'll take a look at just a couple of charts. Klarna, which is a recent IPO, stock symbol is KLAR. They are due to report earnings tomorrow before the market open. Keep your eye on their earnings. This is a new issue, but they are one of the companies in this space that does well. But the recent IPO, not much yet, right? But it's a $30 stock. I believe they're optionable, right? Yeah, they're optionable. But mostly, this is the space that I want to keep an eye on, along with Affirm, AFRM. Note, solid base here, building out. Nice range, $10 range, so not extreme. They just reported earnings back on November 6th, and actually I can clear out my drawings for a quick second and see what did they do. So they had an earnings beat. They doubled their reported earnings, were double their estimates, so a 100% surprise on EPS. Their revenue was higher, over almost 6%. So that's why I say these are some companies to keep an eye on, along with everyone's least favorite, PayPal. At least they're my least favorite. Again, was in a base, failing right now temporarily, but they also recently reported earnings. Surprise on the upside, surprise on the revenue side. That's why I'm saying keep an eye on these companies, especially as we head into the Black Friday Christmas sales. This is where some of those companies are, where they exist. Another is, I think it's SEZL, right? Sezzle. Uh, Try again. There we are. They recently reported earnings, 10% surprise, 11% higher revenue. Small company, but still $50. You can see this company has certainly fallen off. Then that was based on an earnings beat, but they must have guided lower, or had infrastructure problems. So they're below their 200-day. That's a 200-day moving average. Certainly down on a weekly basis, but this whole group is worth keeping an eye on, as well as Dollar General holding up just fine in the recent period from, I mean, even here's that should be about the 10th, right? That's the 20th. So note that the week where stocks fell down, Dollar General actually went up, sitting in a fairly decent range, tightening moving averages on a weekly time frame though. Look at the difference. Dollar Store is way low, well below its 200 period moving average on a weekly chart. Uh, that's a stock that I'd view as a potential rebound stock. Very cheap, 15 times forward earnings. That is not expensive. And their earnings most recent, slight surprise on revenue. So the question there is, have they been impacted uh, by cheap stuff from China? Let's ask it that way, right? Tariff oriented. But do Dollar General or Dollar Tree expand in price as we go through the holiday season? So buy now, pay later. Dollar stores, the low end of the market on the retail side, worth keeping your eye on as potential for trades, short-term trades, or even owning slightly into the future, right, into 2026. Also, Dollar Tree, 16 times forward earnings, so not expensive. Um, Missed earnings back here in the early part of the year, beat earnings in October, but would have to take more of a look. I don't know why these don't line up because that's September. Maybe they must have a funky earnings reporting period, but doesn't matter. These are the two key areas on the retail and economy side that I would argue are worth keeping an eye on. So, all right, with that, that'll end Breakfast Club, and we will be dark this Wednesday, and back next Monday ahead of Thanksgiving. We'll be dark the day before Thanksgiving, obviously, and then we'll be back. We will be back Monday the 24th, and then at the beginning of, oh my gosh, it's almost December. So and then back at the beginning of December. So hope everyone has a great day trading. Millionaires Trading Club at 10:30, Income Masters at 11:30. And again, Joe, we'll try to get those positions addressed during the MTC update today. So for Jeff and for me here, Traders Reserve, thanks for joining us today, and look forward to seeing you again next Monday. If you're AI2, I'll see you at 4 o'clock today.